My name is Brian Korn. I'm a securities lawyer at the law firm Pepper Hamilton. I'm based in New York and also work out of our California offices. I'm originally from California. And I'm going to set the stage in the next, I think I have 25 minutes to tell you about how corporate finance works and crowdfunding's role and spot in that world. And that's going to set the table for the remainder of the afternoon, which is really talking about equity crowdfunding, funding of business enterprises using crowdfunding, the debate, and some other of the presentations. So I'll go through this fairly quickly. All these slides, by the way, are in the back. I also wrote an article called The Trouble with Crowdfunding, which was printed in Forbes magazine. That's reprinted in the back. And I've been on talk shows and radio shows and discussing, not that I think crowdfunding is a bad thing, but I just think that there's a lot of expectation around what people view as crowdfunding versus what I think the reality is going to be on the equity side. And when I say crowdfunding, I'm talking about equity crowdfunding, although obviously I know that a lot of people have made a lot of money in rewards-based or donation crowdfunding. So corporate finance, what is corporate finance? Companies need money to operate. They can either make it, borrow it, or raise it. Finance is generally divided between loans and securities. Securities are investment contracts and are regulated by the SEC. Loans are generally single borrower documents that are regulated by the federal and state banking authorities. The most common pre-IPO venture capital investment is a preferred stock, which will have a coupon. It will have protection against anti-dilution in the event there are later rounds at a lower valuation. And it will also be convertible into common stocks so that the liquidity event is at an IPO. The other most popular liquidity event is an M&A transaction. Who regulates corporate finance? Everybody. I ran out of space on this slide, but anybody you can think of has some slice in the corporate finance world. The most prominent regulators are the SEC. The CFTC regulates swaps and swap vehicles. And then these are your banking regulators: FDIC, Federal Reserve, Treasury Department. FINRA is very important in the broker-dealer space. People who take Series 7 exams, Series 24, they are registered reps, and they are subject to FINRA regulation. The CFPB, Consumer Financial Protection Bureau, was created by Dodd-Frank in 2010. That's a new agency. It actually went through a little bit of a legitimacy crisis over the last couple of years, and finally the Republicans relented and allowed Richard Cordray to be installed as the first chairman of the CFPB. And their role is multi-agency, multi-jurisdictional, and they're effectively a consumer protection financial watchdog. And then what regulations govern and who regulates depends on what you're talking about. So it's not split by company, it's split by product. If you have loans, you're talking about the Federal Reserve. If you have securities, you're talking about the SEC. If you're dealing with broker-dealers, you're dealing with FINRA. Again, we talked a little bit about loans versus securities. Security is an investment. It does not mean that it's an at-risk or an equity investment. It could also be a bond, but it's generally a contract that can be sold to somebody else or transferred to somebody else, and then they will hold the same interest that the previous owner had, as opposed to a credit agreement, which is a one-off signed document between the borrower and the lender that has limited assignment rights. That's the biggest distinguishing feature. If it is a security, then it's regulated by the SEC. If it's a loan, then it's regulated by the banking authorities. There's a blurred line here, distinction where under commodities rules, loans are actually securities, but I can talk more about that after if you'd like. There were a number of laws in place that starting back in 1933, 34, 39, 40, this is the basic framework of our securities laws. The Securities Act of 33 governs offerings, what you can say during an offering. The 34 Act governs what companies must do once they are already offered or public. This includes your 10K, 10Q annual and quarterly reports, which you may have heard of, 8Ks. 20F is a foreign private issuer annual report. There's a couple of other laws I'm sure you've heard of, the Investment Company Act of 1940 for mutual funds and other private funds, and the Advisors Act. So starting around 1995, we see a new wave of legislation that attempts to overlay or change parts of the list on the left. And the Private Securities Litigation Reform Act reformed what plaintiffs must actually plead in order to bring a case. Dodd-Frank in 2010 was critically important in swap reform, in investment advisor registration reform, in banks too big to fail. There's also some random rules that come out of Dodd-Frank, such as bad actor disqualification, which we can talk about. Conflict mineral disclosures came out of Dodd-Frank, and a handful of other random rules that come out. Volcker rule is another one, which they actually don't even have the rules out on yet. And then the Jobs Act, which many of you have started, stands for Jumpstart Our Business Startups Act of 2012. That also is a multidisciplinary law. Its primary features are the IPO on-ramp, which makes it easier supposedly for companies to go public by allowing them to have less disclosure. And it also puts in place private placement reform and, for the first time, crowdfunding. This just talks about the place of crowdfunding within the securities laws. A new section was created for crowdfunding, 4A6. So most of your private placements are under this 4A2 law, which many of you know of as Reg D or Rule 506. Those are private placements to accredited investors. That's a 4A2 safe harbor. Crowdfunding is a separate and distinct safe harbor. And all of these are not mutually exclusive, so you can take advantage of more than one in the same transaction. The other thing to remember is that we are in a world of registration and exemption from registration. So a security is either registered with the SEC. An example of that are all of our listed securities. Everything that trades on securities exchanges are listed, registered securities. When a company registers to do a public offering, that's a registration statement that they list with the SEC. There's public disclosure. You can go to the SEC website, look up any company that's filed a registration statement, read the prospectus, read risk factors, read financial statements. The other side of that is private placements or exemptions from registration. This is the world of hedge funds. This is hedge fund fundraising, private equity fundraising, other private placements, pre-IPO private placements. Those are all in the exempt world. Like I keep telling myself I should put a slide up. You think of the world as registered and non-registered. What we're talking about here is the non-registered world. And until 2010, this world existed outside of most public view and generally was unregulated, and you satisfied yourself that you met the private placement exemptions and you could proceed with your transaction. So the Jobs Act, the title is to increase American job creation and economic growth by improving access to the public capital markets for emerging growth companies. Crowdfunding is Title III of the Jobs Act, online fundraising, but as I say here, there's a catch. There's two other important aspects of the Jobs Act that you should be aware of. One is the private placement reform. These go into effect September 23rd for Reg D 506 private placements. So for private placements to accredited investors, you can now engage in what's known as general solicitation. A hallmark of private placements up until now has been that you do your placement privately. You don't go out and advertise. You don't ask for investors. You offer to people you generally know or have a relationship with. That's changed as a result of the Jobs Act. The SEC has put out rules from their meeting on July 10th. They go into effect September 23rd, and effectively it says for a private placement to accredited investors only, you can advertise. For private placements that go to accreds and non-accreds, you can go up to 35 non-accreds, you still can't advertise. And if you offer to any non-accreds, you have to provide them with a disclosure document. Now, what's an accredited investor? An accredited investor is an individual. There are a couple of definitions that include institutions and banks and insurance companies, but an individual that has $200,000 a year of gross income over the last 2 years with the expectation of the same income in the current year, $300,000 for a married couple, or $1 million in total net worth. So if you're retired but you have net worth, you can meet through the net worth test. Now, Supreme Court same-sex marriage case actually created a new class of accredited investors because people who were previously married under the same-sex rules of those states were not counted as spouses under the securities laws. The Supreme Court said if you're married legally in the state that the wedding takes place, then you are legally spouses under federal law, regardless of what the state law of the state you're living in. So two same-sex spouses who together had a $500,000 net worth apiece can now qualify as a $1 million net worth accredited investor. If you go to my website, there's actually an article on all the different implications of the DOMA case on corporate finance and security. It's actually fascinating because for compensation purposes, you have to declare in public company comp tables your spouse's equity interest. You can have your trades potentially matched against your same-sex domestic spouse and have to disgorge your profits if you have an opposite way trade in the same 6 months. I'm sure these are all things that the Supreme Court didn't think of at the time, but they ripple through. So crowdfunding, capital raising online while deterring fraud and unethical non-disclosure. Somebody in Congress thought of that. It's, again, Title III of the Jobs Act. There are two perceived needs from crowdfunding. Smaller retail investors don't have access to early stage opportunities, and that startup companies don't have adequate access to available capital. A lot of this was driven by the Facebook capital raise and then IPO, where for the first time in the light of the public, people were sort of witness to the venture capital process, and they also saw that the stock was being offered to the public at much higher valuations than the earlier round investors, and people thought, well, that doesn't sound fair to me. So Congress put this in. Widespread support. Jobs Act passed something like 395 to 20. It was very one of the most bipartisan supported bills in the last couple of years. So what does that leave us now? There are currently three types of crowdfunding. We have rewards and donation-based, which is your Kickstarter, Indiegogo. There's a site called YouCaring. I don't know if you've seen that, where you can donate to people who need surgery or other types of healthcare needs and can't afford it or aren't covered. These are not sales of securities. Not that they're bad things or that you shouldn't do them, but they're not investments. You're not expecting a return. You're usually buying a product, or you're getting some other type of reward, like a hat or a t-shirt. So the SEC is not really interested in this column on the left. You still have state level anti-fraud rules though. So if you say you need an operation and you don't need an operation, that's a criminal offense. You're raising money online. It's actually a federal offense because you're doing it through interstate commerce. And you could go to prison if you are intentionally fraudulent in donation-based crowdfunding. Something called bad actor disqualification, that came out of Dodd-Frank. It was also part of the July 10th SEC meeting where they allowed general solicitation. And essentially, if you're an issuer or you're an advisor of an issuer and you're engaged in a private placement, you have to disqualify all of your, you cannot use the private placement exemption if you have bad actors on your board, in your management team, or in the officer group that's working on the transaction. A bad actor is generally somebody who's been convicted of prior securities fraud or financial crime. It does not include people who are convicted of non-securities or financial related bad acts. So murder, rape, robbery, treason, arson, DUI, those are not disqualifying bad acts from the private placement rules. But if you have made a false statement to the SEC, if you've been to prison in the last 5 to 10 years, you may have to actually step down from your position in order for your organization to go through the private placement process. And it's actually a lot of work right now because all of the funds that rely on private placements, private equity funds and the like, have to actually screen everybody out and discover if they have any bad actors within their group. Equity crowdfunding to accredited investors, such as Funders Club, Angel List, Our Crowd. These are sales of securities through crowdfunding, but they're sales to accredited investors only. Now it's interesting, somebody might say, well, isn't a website general solicitation? Yes, the SEC said that you can do crowdfunding to accredited investors. There's special no action letters in April, and they also are not broker dealers under the same no action letter. So That's where we are now. You have accredited investor crowdfunding. You can go to these sites. If you meet the income qualifications, you can click through the menus and you can see the different offerings that are available. Now, what is Jobs Act crowdfunding? Jobs Act crowdfunding is equity invest to the public. So no income restrictions, no accredited investor status. Everybody off the street can effectively invest in any transaction they want. That is general solicitation. It is not registered, so it's currently illegal. The SEC had until last December 31st to put out rules. They still have not done that. There's a delay right now. A lot of people have theories about the delay. Part of it is the turnover at the chairmanship of the SEC. Part of it is that the SEC wrote Congress a letter before the Jobs Act passed saying we're against crowdfunding. We think it's dangerous and could lead to potential fraud. And also, what's interesting, the bad actor disqualification I just talked about, not that they were actually making rules about crowdfunding, but in the SEC release from July, they said, we're also going to disqualify bad actors from equity crowdfunding and from something else called Reg A+. So that's another layer of complexity upon this. The SEC has this on their website. It's been up for a year and a half. It basically says we're, and it's very unusual for them to actually do a preemptive strike like this, but they're basically stating that do not crowdfund until we tell you it's okay. Who can't crowdfund? So non-US companies, you're out. Public companies are out. Investment companies, mutual funds, private equity funds, business development companies, asset management vehicles, anything that doesn't look like a real working operating business or company, special purpose acquisition companies, shell companies, are all out. So they are really only targeting those that make it. Now, in the Jobs Act, they list what the requirements are for public equity crowdfunding, even though the SEC hasn't put out rulemaking yet. The SEC's rules can only be tighter than what's in these statutes. The SEC was created by Congress. Congress said crowdfunding will be lawful once the SEC enacts rules, but by the way, SEC, these are the rules, this is the minimum standards you have for crowdfunding, and you can't do anything that's more permissive than these rules. And that's why I say the trouble with crowdfunding, because these are very restrictive rules. It makes it very expensive to comply, that even if the SEC had a one-page release that said, by the way, crowdfunding as related in Title III of the Jobs Act is now law, it's still going to be a very expensive process. And we can explain why that is. But I've compared here public crowdfunding in the Jobs Act, something called Reg A+, which is a small offering exemption, which used to allow people an exemption from registration if you were raising up to $5 million. The Jobs Act, a different part of the Jobs Act, actually raises this amount to $50 million. So a lot of people are looking at Reg A+ as the real opportunity in the Jobs Act, not crowdfunding. And then the Reg D 506 under the new rules. So maximum total you can raise. Public equity crowdfunding, $1 million for every 12-month period. Reg A+, $50 million, Reg D, unlimited. I've tried to put boxes here to kind of score where I think the winner is, sort of like a tail of the tape thing. Number of investors, public crowdfunding, unlimited, but subject to, see above. Reg A+, unrestricted, and Reg D, also unlimited accredited investors up to 35 non-accreds. And so as you go down here, you'll see the maximum investment per investor in public equity crowdfunding. If you make less than $100,000, the most you can invest in crowdfunding is $2,000. And that is across all crowdfund investments you have over a 12-month period. That's not per investment. If it's higher than that, then I believe it's 10% of your income or net worth. Investor disclosure, you have to prepare a prospectus-style disclosure document. It has to be filed with the SEC. You have to present this document to investors at least 21 days before you sell to them, so there's a 21-day hold. Private placement world, no disclosure requirement. So now they've proposed that you have to file a Form D, which is really a one-page easy form I can do in about 10 minutes. And that has to be done 15 days before, but that's not the law yet. Reg A+, again, you also have to have a disclosure document. It's not as extensive, and it has to be filed with the SEC. So these two require SEC filings, and they really require somebody to show their face to the government and say, here I am, I'm about to do this. Here's what I plan to give people. Please call me if you have any concerns. Intermediary, this is another big issue. Public equity crowdfunding. You have to use a funding portal. This was not the case in the bill that came out of the House, and when it came to the Senate, a group of Democratic senators, names you probably know, and I'm not being political or anything, but I'm saying that there were major amendments to the Jobs Act when it went through the Senate that made crowdfunding very unattractive, and I think a lot of people think made it the case that no one would really want to use crowdfunding as a viable fundraising tool. This amount up here, the $1 million, used to be $10 million. It was $10 million in the House version. Went to the Senate, they cut it down to $1 million. They added this funding portal requirement. What's a funding portal? Funding portal is a broker-dealer like Bank of America, Wells Fargo, Barclays, that has registered to be a crowdfunding intermediary, and none of them have. Or something that decides to be a funding portal and registers as a funding portal with the SEC. And I've heard from a lot of people who said they want to start doing this, but remember, if you're not a broker-dealer, you can't be compensated to sell securities. So you're really a website provider, and you can only get a fee based on the transaction. You can't get a fee based on the success of your sales efforts. And that's what turns off a lot of the other broker-dealers. Subject to SEC reporting, you're going to have to file at least annual reports with the SEC. Anyone who's been through that process knows that that's not a light task. It's not something that one person can do. It's a major undertaking. So again, private placement, no. Disclosure liability, you have full disclosure liability, what we call strict liability. If you have something in the document that's wrong, you are liable. On the private placements, it's anti-fraud. You have to make a misstatement with intent to defraud. It may not sound like that matters, but strict liability is a very tough standard for an issuer. It means that somebody can sue you if something turns out to be wrong. The column on the right, you have to be sued only when someone can prove that you intended to defraud them. And generally this chases away most of the plaintiff's lawyers, whereas in this world they're all over you, especially if something goes wrong, which is the only time anyone complains. Your shares are going to be restricted, which means you can't sell them publicly for a year. Same thing under the private placement rules, although you have 6 months here. Possibly state filings and advertising, again, not allowed, whereas in private placements it's allowed if you only sell to accredited investors. So it's a big task. It's not something that I think is going to be game-changing, because to raise only up to $1 million, and I don't mean to sound like that's not a lot of money, but to get the resources in place to do that, you're going to have to pay a funding broker, funding portal, you're going to have to prepare a disclosure document, you're going to take strict liability on that document, you're going to have to file with the SEC and then file every year. You're going to have to limit what you can raise and what investors can invest. The funding portal who does your transaction is going to have to do a background check on all of management, and I'll get into that in a second. They also have to inquire to the investor to ensure that they're meeting the investor cap limits, that they understand that these investments lose money, and that they are investing in a highly risky security. What else here? So a lot of people made a big deal about Facebook. When they went up to 500 shareholders, they had to go public. There's a rule that says if you have 500 shareholders and $10 million of assets on your balance sheet year end, you have to file as a public company with the SEC, even if you're not doing an offering. And that's what Facebook did. And a lot of you remember they did a private placement with Goldman Sachs that closed in January of whatever year that was. And the reason they did that is because they wouldn't have the number of shareholders on their books at year end, which would cause them to have to file a public offering document until the following year. And so they bought themselves a whole other year doing that. They've raised that from 500 to 2,000 in the Jobs Act. They've excluded employee shares, and they've also excluded crowdfunding shares. So if you crowdfund, it doesn't count towards your 2,000 shareholder forced, what we call the forced public rule. Again, this is about funding portals. You're exempt from broker-dealer regulation, but you are subject to FINRA regulation. No one really knows what that means. It sounds bad. You know, they can still call you and do an investigation, so it's not, I don't think you're really getting much there. You can't offer investment advice or recommendations. You can't solicit purchases, sales, or offers. and you can't compensate employees based on sales. So what do you get paid to do? You get paid to be a host, you get paid to be a portal. You can direct traffic to your site if you're a portal, but you can't say, by the way, we have this really great deal going on, you should check it out. That's crossing the line. More funding portal requirements, you guys can read a little bit about this, but here's the investor reps process that we discussed. So my basic premise with this is I don't think crowdfunding is bad. I think that it's a useful process. I think what came out of the Jobs Act is an attempt to discourage people from really considering it as a viable corporate finance tool. Now, unfortunately, the SEC, as I explained how the pecking order goes, can't change the Jobs Act because the Jobs Act is a creation of Congress. Only Congress can change its own law. So what the SEC is going to come out with is going to be even more restrictive than this, unless they decide that they're going to adopt this and have no changes, in which case it's already to the point where the cost of an issuer preparing a disclosure document, filing it with the SEC, taking liability, so being sure that the statements are accurate, doing diligence, doing the background checks, having a funding portal do all of this, waiting the 21 days, and then having to file 10Ks every year. If you're looking to raise, and I don't know if I mentioned this also, there's a financial statement requirement. So under $100,000, you have to provide reviewed financial statements by an accounting firm. 100 to 500, you have to provide them with something called certified financial statements, and over 500,000, you have to go through a real GAAP audit. So that's another cost. So these are not projects, these are businesses. And you're going to have to go through, now it may not be a big deal to have audited financials if you're a very early stage or you have no financials or no operating history. But again, you are signing on for this annual disclosure requirement, and you're really becoming a long-term partner with whoever decides to invest in your company.